topics that you want me to cover, please fire away. So Clifford, I don't know if you didn't hear me earlier, so I'm going to start from the top here on ZIM. So ZIM's going to announce on May 22nd. And what am I expecting out of that earnings? I think that shipping rates should be better than expected. There's a very low expectation on shipping rates. And I think that ZIM has very efficient ships that run on natural gas. So I think they could operate well. And that the market's really expecting a terrible earnings. But I think they could surprise. They can make a little bit of money that would send the stock flying. And if they announce a dividend, which is possible because they generate free cash flow, that could also send the stock up. So we'll see where they end up. But I'm optimistic. I'm buying into ZIM. I don't buy. It's a high risk stock, so I don't buy big positions in high risk stock. But I continue to buy stock in ZIM. All right. So why is the short float so big? I'm not quite sure. Let me see if I can get some statistics on there. So a lot of their shares are shorted. And I think that, the stock had such a peak. It attracted a lot of short sellers. You see the stock, when we had the supply chain issues, it was at $84 a share. Now it's at $10. So it's kind of like the vultures are circling this stock, looking at it, thinking, oh, it's going to go out of business. I look at it, and when we look at the balance sheet, they have a fair amount of cash. So they have a fair amount of cash. Okay. They got cash. They have leases on some ships, which is understandable. And they have some long-term debt, which is understandable as well. But a lot of their ships are paid off. They don't have to rebuy ships. They could just use them, depreciate them. So when we look at free cash flow, the company has cash from operations. If you have cash from operations and very little CapEx, that is free cash that you can use. You can use it to put it in the bank, put it in short-term investments, have a dividend. You can do a lot of things. So those are the things that keep me in the game with ZIM. And we'll see. It'll be interesting to see if ZIM rallies and the short sellers have to end up buying the stock, which will further make the rally go. That's why investing is really interesting, right? Is we make these decisions and then follow through. Put my money where my mouth is. Let me see where I am with ZIM and from a gain and loss. So on ZIM, I have a 3% loss. I've invested $8,762 and my stock is worth $8,500. So I'm doing okay. If the stock rallies, this is the type of stock that will jump up 10, 20% in a day. It could fly up 30, 40% in a month. We've seen it do that before. We'll see what happens with ZIM. Was going to ask if only invest in U.S. with ZIM. You answered the question. Yeah, so that's a good question. Most of my investments are U.S.-based companies, and there's a lot of reasons for that. This is where I grew up. This is where I got educated. This is where I've worked, and it's familiarity. But I own ZIM, which is an Israeli company. I own StoneCo, which is a Brazilian company. I own Ternium, which is headquartered in Luxembourg, but most of their operations are in Mexico and Latin America. So that's kind of an international play there. I own Alibaba, which is in China. And I own a small semiconductor company in Taiwan. It's called Hymix. So I do have some international companies. But most of the investments I have are in the U.S. and it's because familiarity. It's like, hey, I know Meta. They're in California. I live in California. I know Alphabet. I've known Alphabet for a long time. I've been an investor in Alphabet for a long time, as well as like United. I fly United, so I get to know the business there and so forth. Good question. All right. So any REITs that I like. So the REITs that I'm invested in, and keep in mind on REITs. So REITs are a real good investment if you are looking for income. So anybody out there that's either really likes income, no matter what age you're in, but maybe you're older and you're like, hey, I'm about to retire, or I am retired and I need income from my investments, then you can invest in a REIT and then that REIT pays a really nice dividend. So they have a very good place. Now, I invest a little bit in REITs because I'm also a real estate investor. I own investment properties and I rent them out to, residential tenants and they pay rents. I have positive cash flow. I've been a real estate investor for 15 years. Having said that, I already have so much capital invested in real estate that I try to manage or limit how much I put into REITs and diversification. But there's some REITs that give me access to some investments that I really like. My favorite one is CareTrust. CareTrust is an investor in long-term elderly care, where you have an older person in the US that needs to live somewhere and they need health care included in their living situation. It's a really well operated REIT. The stock price is doing well. I think I'm up on the stock 31%. I've invested $33,000. My investment is worth $43,000 and they pay a 4.73% dividend. So that's great. That's my favorite REIT. My second favorite REIT, we're going to take a walk on the wild side, is MPW, Medical Properties Trust, high risk real estate investment trust. I am losing 35% on that investment so far. I've invested $8,318 and my investment's worth $5,434. MPW, I believe, is going to make it. And there's some good news that's come up in the last month, 2 months. That's an interesting stock to track in 2024. And that's a high risk REIT. Usually REITs are not high risk. And then the third REIT that I'll talk about is Vici. Vici owns properties that are gaming properties, casinos, Vegas casinos like Caesar's Palace, Mandalay Bay, really Bellagio, just really premium properties, as well as other properties around the world, the United States, where they're more regional casinos. Vici is really well operated, and the consumer is traveling. People want to get out and have fun. So those are the three REITs I would put out there. Other REITs that have caught my attention is Public Storage. Look pretty good, but again, I think I provided the comments on the fact that I invest in real estate to begin with directly. So I don't buy a lot of REITs for that reason, but Public Storage look good. And then Digital Realty, which owns data centers. I've looked at that as an investment. That looked good. It got pretty priced up because of the AI hype, but that one also caught my attention. I really like Vici, PT. I think it's a really well-run company. I like the space they're in. I'm a pretty down-to-earth guy. I'm maybe from a going out late at night and stuff. I'm probably a boring guy. I don't drink. I don't really gamble. And I go to Vegas and have a great time. And I go to those big casinos and I go to shows and I take my wife. We have a great time every single time we go to Vegas. And I think of those casinos and I'm like, geez, man, they're making so much money because a lot of people are getting out there and having fun. Can't blame them. With COVID being cooped up for a couple of years, there's a lot of pent up demand to have some fun. All right. So So I think I've got the questions answered. I'm glad the sound started to work. Sorry about that, guys. I'll be ready for the next one. All right. So I don't think you guys heard me on the recap of last week, but I'll kind of go through some of it again. The first one I'll go through is Netflix. So Netflix, their earnings from last week was a big surprise, but I really like what they had to report. And what I liked was their revenues went up 15.9%. Their subscriber growth, 16%. Those two numbers are like, great news. I'm in. Their share price went down. They bought back shares and they went from a share count 1 year prior of 452 million shares outstanding to 441. Phenomenal. That's great news. Cash flow went up. And the negative news was that they were going to stop giving out the subscriber data. And that didn't really affect me because I don't use subscriber data in my valuation. Maybe it's an interesting fact that you get out of Netflix, but I don't use it in my valuation. In fact, I could show my valuation in Netflix on the screen. And we'll go over to Netflix. So if you look at Netflix, I mean, my valuation is that it's fairly priced. And at the current stock price, it provides a 3% discount. And I'm glad to pay a reasonable price, a fair price for a great company. Netflix is number one in their category. But all the data that was reported from Netflix on their earnings didn't affect my valuation. So therefore, when the stock dropped, I bought 2 shares on Friday. And if it continues to drop, I will gladly buy more shares. It's interesting how the market behaves. I'll go to the Netflix stock chart. And if we look at the 5-year, Netflix was sold off for silly reasons in the 2022 timeframe. It went down 75% for the number one streaming company in the world. And then it turned around and it went up 200 at the high was 250%. I mean, that's Netflix. It's kind of like, are we going to do that all over again? I'm happy to participate because I bought shares in 2022 and I tripled my money very quickly. It was a very fun ride. Hey, if it's going to set up that way, I don't think it's going to set up that way. I think I'd be dreaming if it did. But again, maybe investors didn't learn their lesson and the stock really drops. I'll be happy to buy shares of Netflix if it continues to drop. So that was the biggest surprise last week out of earnings. I don't know if you guys have any comments there. So Shadow Guy, what do you doing exactly? What do analysts do making their buy, hold, sell recommendations, right? So what I'm doing, I think the question you're asking is, what am I forming a conclusion on a stock? And the answer is yes. I'm trying to give you my individual point of view and opinion on Netflix. And my opinion is that I'm buying it for my portfolio. It's always important to understand, the opinion is coming from who and what does it mean? In my case, I'm an individual investor. All the investments that I'm making, it's my own money. And, on Netflix, I do my own analysis from a free cash flow perspective and a earnings per share perspective. So when I say that I'm buying shares, that's what it means. I never recommend a stock. I'm not a licensed financial advisor or anything like that. So always make decisions on your own. But what I'm hoping is that, as I learned from people on YouTube, when I express an opinion and share with people what I'm doing, it's interesting to people and they can, if anything, understand sentiment of the market, how people feel about Netflix, how they evaluate it, and so forth. Cool. So I'm glad that I gave you some information that was relevant to you, Shadow Guy. Thanks for the question. I appreciate it. All right. So my fair value on Netflix, coming back to that one. I believe Netflix is worth $584 a share. If you guys could see my screen. Now my spreadsheet, it's a model I created, using net present value calculations on free cash flow, as well as calculations and discounting of earnings per share. So to answer your question, I believe the stock is worth $584. It takes into account the growth that I expect Netflix is going to experience. I'm probably more conservative than optimistic. And the reason for it is, if I'm wrong and I was too conservative, okay, then I make more money. But if I'm wrong and I was too optimistic and I lose money, that hurts. So I try to be conservative. Okay. All right. So that's an answer for you, PT. Good question. Okay. XDiv, Verizon will publish its figures. Do you think the shares in telecommunications sector will be interesting again? That's a very good question. Let's get into that. So ex-dividend, probably like 10 years ago, right? Like stocks that seem really easy to get my head around are dividend stocks. Why? Because they pay a dividend. So you go, oh, well, that stock's good. It pays a 5% dividend, where this other stock pays a 1% dividend. Now, over time, I realized that maybe that's not the best investing approach. And the reason for it is I'd rather, see my stock appreciate 50% and it pays me no dividend. That's way better than a stock that doesn't go anywhere and it pays me a 5% dividend. But having said that, telecommunications is a couple of things that I like and dislike about telecommunications. And let me pull up AT&T. I think I have AT&T, but I don't know that I have Verizon. No, I don't. But AT&T is very similar to Verizon, so I'll talk through AT&T and then give you my comments on Verizon. So Verizon, I think 5 years ago was better than AT&T. It was a better quality company. The things that the communications companies have to do ongoing is put a lot of capital back into their businesses. It's a really expensive operation. And if we look at, what we can do real quick is look at the investor page, and I'll take you through their financials and point out the pieces that I don't like of telecommunications. So here we are on Verizon. Let's look at their 10Q. All right, so we're in the statement of cash flows. And this tells us the statement of cash flows is where the money's at. In 2023, they had $28.798 billion of cash from operations. That's where you take their net income, make some adjustments, and you get to that point. They have to put back $14 billion back into the business. Okay. So they net free cash flow, just to keep the math easy, about $14 billion in free cash. Okay, great. The piece that I don't like about telecommunications is how much they have to put back into the business. Okay. Once you take that number and you put it into a valuation like AT&T, very similar companies, you end up getting a valuation on the company, and it provides a reasonable discount. But when you look at the stock price of Verizon, you can see it's been on a downward slope in general. Now, recently it's doing well, which is great. Congratulations if you bought it at the right times. But those are some of the reasons why I'm careful with communications. I'd rather have companies, and I'll show you like you know, Meta as an example. So Meta, Alphabet, Microsoft, these technology companies, when you look at, we just saw Verizon for their statement of cash flows. Now we're going to look at Meta, and there'll be a big difference in statement of cash flows. All right. So you remember this line, you got your net income, cash from operations, 71 billion. And their CapEx is 27 billion, which is, this isn't a perfect example, but you could see a much higher amount of free cash. This is, they're having to put back, let's say, a third of their cash flow back into the business, where on the Verizon side, they had to put half. And sometimes you see even more. They put more than half of their cash from operations. So I think that's what separates, I think, the Verizon's from the Metas. And there was one more important piece that I forgot to cover that is one of the flies in the ointment for me on Verizon. So we went over cash flow, but the balance sheet is where there's a lot of problems too. You look at long-term debt, $134 billion of debt. That's huge debt. Where when you look at a Meta, you have no debt. So it's like, whoa, they don't have any debt and they earn a bunch of cash. And can't seem to find their balance sheet. Let's see here. Here we go. So here's the balance sheet. You got current liabilities, long-term debt, 18 billion. Verizon, 134 billion. So the things I don't like about communications is high debt, high amounts of capital have to be put back into the business. And I find better value and better upside potential in other places like our friends over at Meta. And if you look at the Meta stock chart, this one is interesting. It's just been going up for about a year and a half, up about 400%. But you see this volatility, right? This is what we want. We want volatility so we can come into a stock like this and buy it. Okay. So thanks for the question, XDiv. And hopefully that helps. Just out of curiosity, XDiv, are you a dividend investor? Do you want income? You know, not to get personal, but are you a retired person? Or, you know, if you gave me any pieces there, you know, I could maybe provide some comments that relate to that. I'm 55, I'm happy working. I make lots of money off my portfolio, which is fun. I continue to accumulate it. I've got two kids and trying to set them up so that they have a very good life. I want them to work hard, but I want them to also have, you know, a house whenever they want it and stuff like that. Yep. Okay. So it looks like we agree, XDiv, on the debt level. The debt level is what keeps me away from AT&T and Verizon. And you know what? Part of my worry about debt is we're seeing these interest rates climb. And for a company that has $134 billion of debt, right? So 134 billion. If we have an increase of 1%, let me see if I could do this on the fly. Get that right? I think that's million. So this is how much money 1% amounts to. I think it's $1 billion. So $1 billion of expense for every 1% increase in interest rates. And we just saw over the last 2 years, rates increase, what, 3 or 4%? so when you have high debt on the balance sheet, instead of it being 1 billion over the last, let's say over the last 3-4 years, this went up times 3. You're looking at, I'm not sure why they didn't work. You're looking at $4 billion of incremental expense on your balance sheet, on your income statement. And it didn't result because you bought something. It didn't result because you delivered more product to your customer or service. It's just the interest. So that's why debt on the balance sheet is a real undesirable. Is debt can really become a huge problem for a company. And if it gets out of control, it bankrupts a company, because it just ends up, a company has to operate just to pay off debt. And it becomes a really bad situation. So just wanted to add that to it. All right. So did I evaluate? So make sure I didn't skip any questions here. Have I evaluated Boeing lately? Yes. And I didn't like what I saw. Let's get into Boeing. I don't know. I don't think I have Boeing. I'm not following Boeing right now. I think it's BAs. No, I don't have Boeing. If I evaluate a company, it's not even close. I just stay away from it. But I'll tell you the things that I don't like about Boeing. First is I make an investment in a company based on 3 principal decision points. First, and the most important point, is I have to understand the business, and I have to really like the business. Like, hey, I think it's a really profitable business. I think it's growing and it's going to go somewhere. And once I buy into that company, it's also a combination of, do I believe in their management team? You could have a really good business that's poorly managed, and Disney's a good example. They had a CEO in there 3-4 years ago. Disney is a real premium, company. And then they got a CEO in there that, I know he was trying hard, but he just didn't get it done. And the stock prices suffered, the company suffered, just the strategies all screwed up. A lot of things went bad. I think Boeing, their management team, has been doing a horrible job. Not sure, why they didn't learn their lesson from if you remember the 737 MAX issues they had, where some international pilots were crashing. Very sad. A lot of people died. Boeing blamed it on the pilots. And this happened like 10 years ago. There was a documentary on it. Just a very, very sad situation. I would have thought that Boeing would just be completely committed to total quality. And then you're having these issues. It's just a bad situation. So I can't even buy into the company. Can't even buy into the business. Now, if they were making money just incredibly at high rates, like they were making so much money, I just cannot ignore it, it'd be one thing, but that's not the case for Boeing. Let's take a look. So you can see the stock price over the last 5 years. You would have lost 55% of your investment. And I don't know that anybody would argue that, that it's reasonable. The company's been operated terribly for quite a while. So I think that is the first kind of big problem I have with the stock. Now let's look at their financials. So if we look at their growth rate, they have good growth rate recently. They had terrible growth rate in the 1920. Now I'll give them a pass on 2020, right? Who would be buying airplanes during COVID? But the growth rate has been good on the revenue. Okay, good. Balance sheet, debt level. They have a reasonable amount of debt. I think their debt level, debt to EBITDA, I think is okay. So debt to EBITDA is 22. That's super high. I want it to be below 3. And I think it's because their EBITDA is really low. Let's take a look at their financials, their income statement again. Yeah, their operating income is down. Operating expenses is high. So I think their income is really low. So basically, if you have a lot of debt and you're not making money, it's going to be very hard to pay off that debt eventually. So I like it below debt is less than 3 times EBITDA, because at that rate, a company using all their EBITDA, which is earnings before interest, taxes, and depreciation, then you can pay off your debt. If push came to shove, pay off your debt. But at 22 times, I mean, that's going to take forever. Then we look at their free cash flow. Cash from operations is a decent amount, and then it's a decent amount of capital expenditures. Now, I would say that on Boeing, if you follow the stock and you feel like they've made the turn on all these quality issues, it's misunderstood, and you feel like, hey, they're going to grow these cash flows, they're going to repair the income statement and become profitable, their earnings per share look good, it might be an interesting stock. That's the kind of investing that I do. Is, when everybody hates a stock and there's a lot of value, I'm very interested. If everybody hates the stock, just hates it, but you look at it and you go, whoa, there's a lot of value here, that is a proposition I'm willing to invest in. So looking at earnings per share for Boeing, it looks like 24, they're going to have a negative earnings per share, but then it's really supposed to take off. If this becomes reality for Boeing, then this is a very interesting stock. I would leave you with that. If you're seeing this PT, I think Boeing is worth watching, because when they make that turn, I think the stock can double very quickly. If they make the turn, if they get their act together. And now a voice inside my head says it's Boeing. They're going to get it together. This is America's aerospace company. They're going to get it together. If anything, they need to fire their management team, their CEO, and everybody else. I think they've already fired CEOs quite often, but they got to get a team in there that just is got a different mindset, because I think they've made bad decisions at the top for about 10, 15 years. And that could drive this business completely, out of business if they don't get, the right management team. So those are my comments there. Hopefully that helps, PT. Now you got me thinking I got to follow Boeing, because I'd love to pick up a stock when everybody hates it, but there's value. So I'm going to write myself a note to start following Boeing. Thank you. I've picked up having a YouTube channel is pretty fun. Yeah, they have debt, but they don't have crazy amounts of debt. I think let's look at their debt level again. I don't think their debt's too crazy. And here's what leads me to say that. See how it went from 62 billion, 56, 51. So it's going down. So that's good. And it used to be really low. That was really nice. But I think that at their revenue is 78 billion in 23. So I think if they can manage that debt level, really start operating more efficiently, increase their EBITDA, and control that debt level, I think they'll be in better shape. What I would keep an eye on is, first and foremost, if they can make a turn on that quality, right? If they can start delivering planes and have some momentum, like, hey, we're delivering planes, we've had no incidents for a while, and then people get comfortable and confident in the stock, then it'll start to move. I think it's going to take a little while, because it seemed like they had 3 big issues in the last 12 months. I think a door flew off of an airplane, and then some other issues came up. So we'll see how that goes, but I think it's a stock worth following. I'll show you my watch list. So these are the stocks that I'm actively watching. And Amazon, I was an owner of Amazon up until 3-4 months ago. Same thing with Broadcom. But if I'm gonna analyze Boeing again, I might add it, and then I put some notes to myself, hey, if it hits this price, then maybe I'll buy at that point. And I think I might end up putting Boeing in that watch list. It's a good question. Thanks for bringing that up. All right, good stuff. So I think Boeing has a massive moat. I don't care. Whoever wants to start an commercial aircraft company, good luck. You would have startup costs like you wouldn't believe. It would take you 10 to 20 years to start selling your first airplane. I mean, it's the moat that they have and Airbus in Europe have. It's massive. It's huge. And they have other businesses too. When you buy Boeing, you're not only buying Boeing, you're buying a defense contractor, which is positive right now. You're buying potentially a satellite company because they're into satellite technology, although SpaceX is kind of taking that business away from them. So it's interesting. Glad you brought it up. I'm gonna start analyzing it and following it. Don't be surprised if you see a video on my channel one of these weeks or months. All right, good stuff. Thanks for the question, guys. All right, so I think we missed on my volume wasn't working when I was covering what's coming up from an earnings next week. So let me go through that and see. Keep the questions coming. I'll respond to questions as we go. So looking at next week, Verizon, which I talked about a little earlier, is going to announce on Monday. That'll be interesting to see. But usually Verizon and AT&T are pretty steady as she goes. I expect that they're going to come in pretty much as expected. Nucor Steel is on Monday. That's interesting. Albertson Companies are trying to be acquired by Kroger, but I forgot which federal branch of the government's blocking it. So we'll see how that rolls out. So Monday should be a little quiet. Nothing, not a big, popular company is going to announce. Tuesday, I think Visa is going to be really interesting because Visa is a little bit of a barometer on the economy. If Visa is like, whoa, our revenues are flying off the charts because the consumer is spending like crazy, then people will feel like, or investors will feel like, oh, the economy is doing great. If Visa, on the flip side, comes out and says, boy, we're really falling short on revenue because the consumer is really pulling back, then the perception will be, okay, the economy is slowing down. So we'll see how that goes. I'll be interested in seeing the Visa earnings. Tesla is going to be really interesting. I don't know if you guys have watched my videos on Tesla. I'm a huge fan of the company. I think their cars are cool, but their stock price is so overpriced. I owned Tesla for some time, so people can't call me a hater. I think the company's cool. I owned the stock for years, sold the stock. Now I own Ford because I can get Ford at such a better value, and it pays a dividend and generates better cash flow to market cap. There's just a lot of things there. So I think Tesla is having a hard time, and I think the hard times will continue because a valuation of $478 billion or $477 billion is a big market cap for an automotive company, and it's really hard to substantiate it. So we'll see how that goes. I don't think Tesla can bring down the market. It could certainly rally some tech stocks if it announces by some miracle, oh man, we sold more cars and we're going to surprise the market. We'll see how that goes. PepsiCo, we'll see how that goes. I'm not a big Pepsi fan nor Coca-Cola. Never understood those investments for me. I know a lot of people do well with them. GE Aerospace, Novartis Pharmaceutical, Texas Instruments. That'll be interesting because they're a semiconductor company. I know semiconductor has been on a real losing streak. We'll see how that goes. RTX is a defense contractor. UPS is another stock that is kind of a barometer on the economy. We'll see what they say. All right, another question. Another couple questions. Okay. Shadow Guy. Actually, maybe you can explain that. Why is Visa considered a growth stock when it's so established? Okay. Yeah, Shadow Guy. I wouldn't classify Visa as a growth stock. I think it's a high value stock, and principally because they have this network around the world. And I don't know how much growth they've had. Let's take a look. So they're growing at 10%, 22%, 11. I mean, that's very good growth for a company their size. Very good growth. So I guess that's what classifies them as a growth company, is that they've executed really well. And the year that they didn't grow was because COVID. And that's understandable, right? In 2020, people were, the economy was shut down. So you look at the growth in Visa, this is why the stock is worth $500 billion. This consistent growth. If you can grow this way, companies are valued a lot of money. Consistent, reliable, that's why it's worth so much. Okay, so hopefully that answers your question, Shadow Guy. What's the difference between using PE and free cash flow to evaluate? Okay, so my favorite valuation method is free cash flow, because a company cannot disguise much in that metric. Free cash flow is cash flow from operations minus the CapEx, the amount of money you have to put back into the business. And that's the free cash flow you can use to pay a dividend, buy back shares, pay off debt, keep it on the balance sheet, and so forth. Earnings per share is my second favorite metric. And the reason it's second is because it could be manipulated. There's a lot of things you can put on your income statement to manipulate it, like taking depreciation, not taking depreciation, capitalizing something versus not capitalizing something. There's things you can do on the accounting side to influence that number. Charlie Munger didn't believe in earnings per share. He didn't use that. He used free cash flow. A lot of investors, value investors, use free cash flow. I use earnings per share because I think that I used to just use free cash flow, discounting the future free cash flows that a company is going to generate to get to a value of a company. But you have some companies, especially young companies, that are growing very fast, and they are using a lot of capital to continue to grow. That makes total sense. You look at some businesses, that makes sense. Hey, you're growing, keep putting money back into the business. So earnings per share enables me to value a company of that type with a more balanced perspective. So when I do a calculation, I take 2/3 of the value that I calculate on a free cash flow model, and I use 1/3 from earnings per share. So those are my comments there on earnings per share versus free cash flow. Cool. That's your answer, PT. Good question. All right, guys. So, all right, one more question, random. Hi again. Great sessions. All right. What do you think? Hershey stock. I was looking at Hershey's. Let's take a look at it really quick. So look at the growth on Hershey's. Positive growth. Very good. It's hard to believe that from chocolate and candy and so forth, you get this type of consistent performance, but good for them. Now let's take a look at where the stock price has been. Man, look at that fall. That looks really interesting. So they're down 32%. Do they pay a dividend? They pay a dividend of 3%. Man, I really like what I'm seeing. So they're growing. That's good. Let's take a look at earning, debt to EBITDA. Very good. Below 3. Okay. Now let's look at free cash flow. So we got 2.3 minus 771. It's going to leave us with about 1.6 billion. And if we look at, okay. So this one may work. Why don't we do this? Why don't we quickly do a spreadsheet valuation of Hershey's. So see if I can find a company that's similar to it. So you guys can see my screen, right? You can see my spreadsheet. Random, can you see my spreadsheet? All right, so this is Hershey's or Hershey Company, I think. Hershey Company. And I have multiple screens, so I'm going to look at data off of another screen and then populate this spreadsheet in front of you guys. All right, so okay, Hershey's. They reported their last year. They haven't reported this quarter, which is fine. Actually makes it easier because it's just going to be a complete year. All right, so I'm on the Hershey's investor relations website looking at their financials. Okay, net sales look good. All right, so cash that they have on the balance sheet, they have 401 million to cash. They don't have any short-term securities. And then debt, they have okay, so they have about 4 billion in debt and about 400 million in cash. All right. And they didn't get, here we go. Okay. So their cash flow, all right, so this is cash flow from last year, okay? Their discount rate, we're going to use 8% because it's got a good balance sheet from what I could tell. Their growth rate, they were showing good growth rate. So I'm going to grow cash flows by 5% in the first 4 years and then grow 4%. Actually, go 7% first 4 years. All right, so we got there. So the equity value of all the cash flows and this guy here, I'm going to improve a little bit. So if you take all their cash flows that I expect in the future, first 4 years are projected here, And then terminal values, all the cash flows in the future beyond the first 4 years. These are all the cash flows. I'm going to discount them by 8%, which is the weighted average cost of capital I'm going to use. So we get to the value of all those cash flows is $42 billion. I'm going to add the cash, take away debt. If we bought the company, we'd have to pay off the debt. It's like buying a house. You buy the house, you have to pay off the debt. Okay. So we get an equity value after those adjustments of $38 billion. The current market cap of Hershey is $37,730. Shares outstanding are 203 million. So the per share price that I calculate the stock is worth based on free cash flows is $188. The stock is selling for $85. Okay. So it's fairly priced based on free cash flows. Now let's look at earnings per share. Okay. So earnings per share is expected in 2024 to be $9.68. And their growth rate on that's going to be about 6-7%. Okay. Their current PE is, their forward P is 19. This is a reliable food company. I mean, you can go 24. It's a good brand. It's a good company. And I get to a value, the stock is fairly priced. It's got a 2% discount on the stock, which leads me to think if the stock price is going in if the stock price is dropping, right? You got this drop in the stock price and maybe the momentum, especially in today's market with stocks selling off. I mean, I value the company at 188. If it drops to like 170 on a high quality company like this, pays a 3% dividend, I am a buyer of Hershey. I'm going to do more homework on it, but I would be a buyer. That float your boat ex-div. And, you know, I see your comment. At first glance, everything looks really good. I wonder the growth in suites, right? Isn't it incredible that this company has had, because, you know, I guess you're health conscious, because I too am like, well, I don't eat that much chocolate. At least I try not to. But look at this growth. It's just been consistent growth. And I did hear that chocolate prices had gone up, so they may have to increase prices. So when you have that consistent growth, they're doing something right. They're either creating more products and getting more revenue, but that's really impressive. So that's the execution of the business. Now, the Hershey brand is a very good brand. I believe. I mean, I'm not a chocolate expert nor, you know, a food expert, but I could just say Hershey is a really well-known brand. I think if you see Hershey's on the stand or in the market, you're very comfortable with the brand. Hey, I'm going to buy it because it says Hershey. Yeah, I did see that the price of cocoa did rise. It was incredible. Yeah, good stuff. Thanks, XDiv. You guys left me with two good ideas, Hershey and Boeing. All right. Thank you. All right, random. I'm looking at three other small companies, NMIH, ACGL, and KNSL. Great. Let's take a quick look at them. And I think after that, I'm going to end the live stream. Really good session. Thanks, guys. It's been really fun. So if I'm looking at the right symbol here, yeah, it looks like I'm looking at the right one. This is a private mortgage guarantee insurance. Okay. Okay. So mortgage insurance. Okay. And man, nice slope. Very nice. $2.4 billion market cap, revenue of $579 million. So you're paying call it a little over 4 times revenue for the company. Profitable net income looks good. Forward PE of 7, incredible. Look at that. Okay, financials, growth. Oh, baby, look at that. It looks good. Very good growth. So looking at cash flow. Wow, really good cash flow. The cash flow more than 300 million. So quick math, right? 300 million times 10 is 3 billion. So this thing's if I were to put it in my model, it would show that this is discounted. Now here's the trouble with small caps. I have a lot of small caps where I could show you it's discounted by 30%. It's discounted by 50%. And the stocks never move because nobody has ever heard of them. So there's no brand kind of awareness and comfort level. So this one's excellent, by the way. Do they pay a dividend? Let's see here. No dividend. That's surprising. Okay. This one, I mean, the model would say this thing's discounted. I could tell you that right out of the gate. What is really impressive is this upward trajectory. Very impressive. This one is worth taking a look at. And like, if I like this stock, I wouldn't put a lot of capital into it because it's just such a small name. I just don't see how it could catch a lot of investors' eyes and then rally, right? But that's a good one. I think the fundamentals look really good. I'm going to put it on my list. Take a close look at it. All right, ACGL. Arc Capital. Okay, what do these guys do? Okay, so Arc Capital in Bermuda. Insurance. Provides insurance, reinsurance, mortgage insurance. Okay, so they do insurance. All right, so insurance company. Again, man, look at this chart. Very good. So 34 billion, bigger. And forward P is 11. So if we look at cash flow, 5.7 billion from operations, and look at the growth in cash flow. Very good. So this one is also going to model well. Looking at their income. Yeah, these two they both look good. So I'm going to take a closer look at this one, ACGL. So high level, 2 for 2. Those look good. KNSL. And these guys do specialty insurance. So I'm going to give you my comments here, and then I'm going to talk about insurance for a little bit. So market cap, 10 billion. Forward PE, 29. Interesting. Okay. Man, look at these charts. Where'd you find these? Good job. KNSL. So 10 billion. If we look at free cash flow, so this one doesn't have as much cash flow. Is it growing? Yeah, here's the growth. Look at these growth numbers here. They're growing. Let's just go to 2020. They're basically almost 3 times as big as they were in 2020. Now it's a small company. They're 1.2 billion now in revenue, but that's just really, really good growth. And you can see that the market likes it. It's like, okay, there goes the stock, right? In 2020, you could have bought it for 100. You would have quadrupled your money with this small cap. Very interesting. I'm going to take a look at it. So some of the winners I've had that have been good ones is Allstate. Allstate had a couple of tough years. Like they didn't get their business, quite right in these years here. But I put a fair amount of capital into them. I think to give you exact numbers, I have I put $15,695 into Allstate, and I'm up on the stock 32%. So my investment's worth $20,700, and really nice growth in Allstate. So really happy with that investment. The other one is Prudential. Now these are more name brand names, right? Like the other companies we just saw, really good numbers, but I'm always a little careful when it comes to small companies because they're small. They can be unpredictable. Investors don't like unknown names, that kind of thing. The other one is Prudential, and Prudential is actually doing better because you see these really low points. And on Prudential, I have $12,697 invested, and I'm up 25%. And the investments were at $15,806. They pay a 4.5% dividend. So it's been going up. If you buy at the right times with this volatility, Prudential looks good. But the companies that we just saw, those three, the numbers look really good. So I'm going to look at them more closely. All right, so thank you, Ricky. Yeah, cool. All right, so Tutomi, so PRI, I'm going to take a quick glance at PRI, and then I got to run. Primerica, what do these guys do? Okay, so they do like financial services, insurance products, and so forth. So they're a $7.5 billion company, forward P of almost 12. They've been growing their business. Okay, good. Looking at operating free cash flow is about $660 million. Yeah, this one would probably look good. PRI looks good. Do your homework on it, but first glance, it looks interesting. And then AWK. So American Waterworks. Okay, this looks market cap 23 billion, forward P at 22. Stable but growing, good. So remember I talked about, I don't think I talked about utility companies, but here's what I don't like about utility companies. Cash flow from operations, 1.8 billion. Capital expense, 2.7 billion. So you got to put more back into the business than you can get out. So this is a showstopper for me. This is why I don't invest in utility companies. Is it ends up being where you have to rebuy the business every 3 to 5 years, and it's like, whoa. I'd rather have a business like Meta or Airbnb where they just generate a lot of free cash, and then that cash makes the company that much more valuable. So if we look at, they have a $23 billion market cap. If we look at 5 years, it's been on a downward slope. Yeah, I'm not the best person to ask about utility companies. My best opinion on utilities is I've never liked them because of what I just showed, which is when you look at the statement of cash flows, The company generates 1.8 billion of free cash from operations, or cash from operations, and it has to put back 2.7 billion back into the business. So it's like, wait, it should be positive, or the business doesn't make any sense to me. And I could be missing out, but when you look at utilities right now, utility companies are doing okay, but they never like hit home runs. Like the 5-year return on utility companies is like 40%. 10-year return is like 60, 70%, which is anemic. I'd rather buy bonds at that rate, is my opinion. I could be totally wrong, but that's how I see it. So So Tutomi, hopefully my comments aren't taken the wrong way. Good stuff. So guys, thanks so much for attending the live stream. Sorry early on for not getting the microphone going correctly. I'm using this software for the first time, and you can tell. So, but really good session. I plan to do this next weekend for the earnings, kind of recap and review the earnings that happened, the week prior, and then look at the earnings that are coming up. And most definitely show up if you want to talk stocks, and we'll break them open and see what we find. Again, just a reminder, I'm an individual stock investor. I don't recommend any stock. Make your own decisions around stocks. What I hope is to give you my point of view and share with you what I'm doing and how I see it. And hopefully you find it interesting. So everybody have a good night, and really appreciate you attending.